Cesar Gonzalez here, the CEO, director, and co-founder of Sailfish Royalty Corp. Sailfish is a precious metals royalty company with assets in the Americas. We have a stream and royalty on a very high-grade open pit mine in Nicaragua. It's in production. We're receiving cash flow from that. And then we have what I like to call diamond in the rough, a 3% NSR on a very large undeveloped gold project in Nevada in Pershing County called Spring Valley. And we recently divested an asset, which we'll talk about during this time. And we have net cash. We're in the process of declaring a dividend. We've been large buyers of our own shares through an NCIB. And happy to be here with you today, Matt.
Well, good to have you back, Cesar. Fantastic. Saw you back in April. And we kind of went through, some of the thinking that you're going through. I think yesterday's news firms up, certainly to me, the intent. So why don't we kick off with that one about Tocantinzinho? Why now? And why only 10 million?
Okay. So the whole royalty, which was essentially 1.5%, was sold down for 19 million US. This is on an asset in Brazil that has recently been sold itself. It was operated by Eldorado, and now it is going to be operated by a junior mining company called G Mining. And for the most part, this will be G Mining's, flagship asset. They had other assets they were working on, but this is going to be at the forefront. G Mining acquired the whole property in a structured deal, 20 million cash, a 19.9% position for Eldorado, and then 60 million in deferred, cash based on a production decision. So we sold a 1.5% NSR for 19 million against the 20 million that they acquired the whole project for. We liked the price, which is why we sold the whole royalty. We sold it off in two pieces. The first piece was 9, the second piece was 10. The first piece was done earlier this year in the spring. We just closed on the second piece. And, we're in the business of allocating capital. I think that's what any good CEO, what any good management team does in a company. And we thought we were getting a good price, so we sold. There are other opportunities that we're evaluating where we think we're going to get a good rate of return. So we'll deploy capital there. And as part of this transaction, we no longer had any debt. We now have 13 million of cash on the balance sheet. We're receiving cash from the stream on San Albino. So a very different time than when we sold the first half. When we sold the first half, we still had debt on the balance sheet. We cleaned that up. We were getting close to the end of a normal course issuer bid expiring. So we very quickly bought as many shares as we could before that ended. Obviously, based on the fact we thought our shares were cheap, that's the first order. We didn't just buy the shares because we were running out of time. We bought them because we were running out of time and they were cheap. And in this go around, we have a buyback that we're open on, but also we've always had a vision at Sailfish to pay dividends to shareholders. We think that royalty companies, when they're able to, should pay dividends as a form of keeping management disciplined, as a form of returning that cash flow to investors. Royalty companies have very high margins. And in other sectors, oil and gas and base metals, the royalty companies pay big dividends. And so we have decided, I put it in the press release announcing the close yesterday, that we are going to be formally announcing a dividend policy. So it's not out yet. I can give you a feel for what it'll be like, the size, whether it'll be quarterly or not, but it's coming. A formal policy is coming.
Right. Okay. Look, last time we spoke, you weren't quite sure what you were going to do with the company, right? So it was a case of, you said to me, it's not a big portfolio of royalties that you've got. It was so it would fit nicely into someone like a decent sized royalty company, and you're hoping to be able to do that. Those conversations didn't materialize. Remind me why not, and why that's affected your decision making and going down this course of action. Why were you not attractive to other royalty companies?
So we went into the year wanting to do M&A. We think that consolidation among the smaller guys, of which we consider ourselves to be, it's just the fact. If you look at market caps, we think that the tiering is greater than $1 billion, between $500 million and $1 billion, and then everybody else is lumped in that last category of less than $500 million. And we're in that that last category. To me, it's actually means you have a lot of upside, but you have to figure out the best way to become part of a diversified portfolio, a more diversified portfolio. And the discussions about Tocantinzinho, the 2 transactions we did with 2 royalty companies, right, Metalla and Osisko gold royalties, came out of the discussions about the broader M&A strategy. So I was on the phone with Brett and with Ian and his brother Lawrence, not just about talking about TZ, but talking about everything. And what came out of it were those 2 sales. So I think that's pretty good evidence, Matt, that when I told you I was wanting to do M&A, I was serious, and there were conversations that were being had, interest in our not just the TZ, the Tocantinzinho royalty, but in the broader company. But we can only do what we can do when we can do it. If one of those companies had said, "Oh, Caesar, we love your whole company and we want to buy you at a nice premium," I would have transacted. But if they like something in our portfolio that I think is a good price, I'll transact there. We're not one of these guys that it has to be everything or nothing. We do what we can when we can.
Okay, so when people talk about M&A, they're usually talking about acquiring stuff. You're talking about offloading stuff because it's let's be real, it's not your kind of core focus. You've got Mako, which is a solid company, and we'll talk about it a little bit in a second. Actually, you're talking about offloading these things. You're now sitting with this recent income of 10 million cash. You're now sitting on what, around 12, 13 million bucks? Is that about
13?
13, right? Okay,
yeah.
So good for cash, and that allows you to have the conversation around dividends, guys. And can you give us a quantum on that?
Yeah. So I gave an earlier interview that's been going around where I said about $1 million a quarter.
Wow. Great.
The way a dividend has to be paid out is on a per share basis. So we're going to do certain cents per share that'll add up by the amount of shares outstanding. For us, that number keeps going down because we are buying back shares. So it's hard to say it's going to be exactly $1 million, but it'll be close to that.
Okay. So that was the second leg there, which was the share buybacks. You've been doing it for the last 2 years. I mean, not very often, but you've been doing it. What are you going to do with? How much of that are you allocating from your 13 million bucks?
The share buybacks have always been opportunistic, and we actually have done quite a bit. So the tally through today is about close to 7 million shares, well over 6.8. So we have been active. That was our only tool. Now we have another tool, which is the dividend. And this company was created. So you asked, Matt, in M&A, we're only talking about selling. Well, that wasn't the case when we started this company back in 2014. It was an idea that my partner Akiba and I had. We were running a mining company at the time, and we saw some opportunities in royalties. And so we did the stream on San Albino, which was restructured at a later time. We did the acquisition of Tocantinzinho for cash and shares. We bought Terrico for that Spring Valley royalty. So we did M&A when we were buying and building, but now there are so many royalty companies. I'll go back to this, and we've talked about this before, you and I. I did an analysis last night of 17 of them in the precious metal sector to see which one of them were paying royalties and how much they were paying. I'm going to do a slide for our presentation showing our yield versus the other yields. And of the 17, 18, including ourselves, only 7, soon to be 8 with us, are paying a dividend. And if you rank them by market cap, there's a strong correlation between the ones that are big and pay a dividend and the ones that are small don't. So we're going to break the mold. We've been doing that since we created this company and took it public in 2017, 2018. So I'm comfortable with that. We're okay with the pressure of having a big dividend and having to run our business to support that dividend. It's a way of working, another way of working for shareholders, of which I'm a large one, and my partner Akiba is as well, and we have our backer Wexford Capital. So we're comfortable with that, but I don't want people to think, oh, these guys are giving up and they're just selling. No. We bought when we saw an opportunity to buy. We sell when we see an opportunity to sell. And the M&A I'd love to do is a merger, to create a bigger, more robust company out of it, and not just a sell, for cash, for example. We think that Spring Valley has a lot of upside that would fit nicely with some royalty companies that are about our size, that are receiving good cash flow yields today, but don't have that growth on the back end. We've just started receiving cash flow from San Albino, so that's good. We're joining that club, but we have this big opportunity with Spring Valley that it would be nice to couple with even more cash flow, and then you've got a real story: upfront cash flow, and then a bunch of growth on the back end.
Okay, you talk about being okay with the pressure, right? Which is quite a statement. It's a positive statement. But you're going to need some real discipline to be able to maintain a dividend payment of that quantum. I mean, what's that as a percentage? I mean, it's significant compared to, you talk about there'll be 7 other, royalty payers, but they're paying like 1%. That sort of level.
Yeah, they're paying anywhere from 1 to the high. The guys paying the highest rates, which would be like the Nomad. Triple Flag just announced a dividend, and they're closer to 2%. But on average, it's around 1. And we're going to be at today's market cap with the kind of numbers I'm talking about, $1.25 million, so $4 million a year. That's going to be in the mid 5s, so north of 5%, which is high. In the oil sector, there are royalty companies that pay 5, 6, 7, 8%, with commodity volatility. So it's not unheard of for royalty companies. Yeah, we're making a statement. We have the cash to do it, and we're not paying all the cash out at once. So if an opportunity comes across our screens, in 3 to 6 months or next week, and we can make a yield on that, we'll use our cash to do that. And it will add to supporting that dividend, where we get a rate of return rather than just sitting on cash on our balance sheet. So don't be surprised if you see something like that in the near future. But our mission was always to create a company that passed the cash flow through to the shareholders. And I would love to have done more transactions. It's just, I can work in Excel like any of these other executives. And whenever I look at the numbers on some of the things that have been acquired, I just can't, I can't push myself to those levels to make those acquisitions. But those acquisitions have been done. One good thing that came out of this, all these royalty companies going out and becoming public, is that they went out and found royalties from every crevice of every royalty owner in Nevada or West Australia or in Latin America. These geologists or these families that had held on to royalties, they're all out in the public now. Companies that were squirreling away royalties, they've done these transactions where their portfolios have been put in the public domain. And now it's our job as CEOs of these publicly traded companies to create value for shareholders by combining and creating these sustainable, large, liquid, diverse royalty companies like the big boys, which have been excellent investments over time.
Right, but okay. So I want to be clear about what you just said. So you're talking about if you see opportunities in 1 or 2 quarters' time, you will assess those. Does that mean you're giving yourself the option of saying, hey, we're not going to pay a dividend going forward because we're going to make this acquisition, which at some future date is going to bring in the revenue, which will allow us to reinstate a dividend again? Or explain more detail.
No, it'll be a transaction that will support the dividend, so that has near-term cash flow. Near-term
being what? Within 2 years?
No, like right away.
Right, but they're more expensive. And you don't want to blow your brains out. You said you didn't.
It can be more expensive. We wouldn't be doing something the default is to pay the dividend. If we see an opportunity that will allow us to continue to pay the dividend, then we jump on it. That's the hurdle.
But chances are in this market, very competitive market, more and more, you analyzed 17 of them yesterday, more and more royalty companies coming in because it's topical. It's going to get harder to win these M&A battles. You don't want to overpay. No one does. So it's going to get harder and harder for you to actually maybe pick stuff up, certainly the near-term stuff, because everyone's looking for that. So if that is the case, and you either keep your current portfolio or you offload some of it, what's the end game for this vehicle that you've got? This Sailfish royalty vehicle at some point is sitting there with not a lot of income and very few royalties. What are the options available to you?
Well, we've always talk again. You and I have talked about this about doing M&A. They're candidates for us to merge with equally sized companies. They've struggled in this environment, same as we have. It's actually not been a very good environment for the gold sector, gold stocks, royalty companies included. So I'm not too fussed about valuations because it's all about how we trade relative to each other. And look, maybe what comes out of this is that some of our peers get tapped out, and then our view on actually acquiring royalties changes. I have an opportunity in hand, which is something that we have the ability to negotiate exclusively on. So it's not an auction. It's something that came about because of our the relationships we have by our common shareholder. We have access to this incredibly high grade open pit mine in Nicaragua, and other assets that are well within our sphere of influence. So we can get good rates of return. Obviously, it has to be fair for both sides. But going back to your point about what is this company going to be, it's what it's always been. Kiba and I created it in 2014 opportunistically. We didn't say we were going to be a royalty company or a mining company. We are investors in the gold mining sector. And sometimes it makes sense to buy mines, buy exploration projects, build a mine, buy a royalty, sell a royalty. And we're doing all of that. We've done all of that. We've built 2 mines, one in Mexico, one in Nicaragua in the last decade. We've funded exploration in parts of the world like Quebec, West Australia, Mexico. We're funding a heavy exploration project in Nicaragua, along with the production from the mine, funded by the mine. And we've done royalties. We're just investors in this sector. We're doing it through companies with a big backer, Wexford, who we were both affiliated with, both worked at. And it's a different model. It's not that unique. There are companies who have teamed up with the Orion Group. Nomad is their royalty counterparty. They have mining counterparties. I look at the Osisko group of companies. They're very similar. They've got a mining company. They've got a royalty company. They've got more than one mining company and exploration companies. And, we're just entrepreneurial guys who see opportunities in this sector, and we're pursuing them. So it's very hard to put ourselves in one bucket and say, this is our strategy. Strategy could change. But for the time being, with our royalty company, we have sold one royalty out of our portfolio. It has changed the whole outlook of the company. It's allowing us to pay a dividend, tons of cash. We're receiving cash now. And we are open, as I said before, to M&A. But if the environment changes and we see opportunities to actually deploy capital and things, we'll go the other way. We'll start doing what we did since 2014, which is to build up the portfolio back up again. But right now, I think the best way to do that is through consolidation.
So we should expect a name change soon then?
We've run out of billfish. We're actually using the swordfish name for another company we're creating, which will be a silver-focused company. And that's where Gavilanis, our silver asset inside of Sailfish, is going to go into. And that's another point I'd like to talk about. There are some royalty companies that have taken exposure in operating assets. And, Osisko had what they now call Osisko Development. It's a separate company. They still have a big shareholding in it. Sandstorm has their hot maiden interest, which is inside of the royalty company. EMX, they just did 2 big royalty acquisitions, but before that, they were, I'd say, more weighted toward operating assets versus royalties in terms of value. They had a lot of exploration properties around the world. And, so it's not unique. And we see a lot of value in taking that operating asset we have inside of Sailfish and pushing it out into a separate vehicle and holding on to some stock, pushing out the stock to shareholders. So, Matt, you're just talking to an investor in the sector. We get involved in everything: exploration, development, production, and royalties.
Okay, let's. I wait to see what you decide to do there, or how you decide to announce that. San Albino, I think you mentioned a number, $150,000 a month. That they started officially July 1st. They've been at it a little bit longer. That's obviously very comforting, but it doesn't go anywhere near to paying the dividend quantum that you've mentioned. So you're not going to be able to use that as a backstop, nor indeed whatever you spend on share buybacks. So you're putting pressure on yourself there. You said you're comfortable with it. Is San Albino going to be capable of delivering more for you? And what's that ramp up look like?
Yeah, absolutely. So there are two components to San Albino. The first is the stream, which is equivalent to a 3% NSR. That's what we're receiving cash on now. And that is on the mine that has the resource, where the infrastructure is right next to it. It's about a 3.5 square kilometer postage stamp within a broader district that our team at Mako has been very focused on exploring. They put out a press release earlier this week that talked about Las Conchitas, which is the area where will be our second production center. That area is covered by a 2% NSR. So not a stream, it's a straight NSR, and it's only 2% relative to the 3% stream on the 3.5 square kilometers. But there's a scenario where you have San Albino, operating at a similar rate to what it's operating at today. And then you have Las Conchitas coming online at the same time. The capacity at the mill in Nicaragua is up to 1,000 tons per day. We're right now trying to get up to 500 tons per day. We're getting very close. I get the daily reports, and we're getting closer and closer to being able to operate at that on that basis on a normalized level. And when those two are running at the same time, depending on the gold price at $1,750, $1,800, we get very close to having the cash flow to support that dividend. But that's a static assumption on just San Albino. There are other things we can do in the interim to try to backfill that dividend. And with the cash we have on hand, so San Albino covers all of the expenses of the company and then some. We're running the company very lean. I don't take a cash salary. Akiba doesn't take a cash salary. We have very few employees. It's a royalty company. It's not like we have to have.
Yeah, but you take fees. You take consultancy fees, right? So you works for it, right? Don't you?
No. What we take, there are consultants who are hired by the company. That's not me. So if you look at our financials, what we have taken are bonuses that are used to exercise options. So, and we've made that very clear in our last executive compensation filing. There's a footnote that says 100% of this was used to exercise options. So the cash comes out and it goes right back in. So we consider that a non-cash form of compensation, because the end result is there's shares that are in our name, but the cash goes right back into the company.
Good news. You're going to get dividends on them though.
Exactly. So that's good. Yeah. And everybody else who owns shares is going to get dividends on that.
Okay.
But, we have a CFO, we have a controller, we hired a VP corporate development, Paulo Lustrito. All three of those do get cash compensation. Paulo is working as a consultant. So is Brian, our CFO. In fact, Peter, our controller, is. So all three of them are. But, Paulo, when we spin out Swordfish, he's going to be the CEO. He's going to run that. And his focus is going to be on Swordfish. His role with Sailfish will be diminished, and the corresponding compensation will go down. So we're trying to run Sailfish as lean as possible, because there really isn't a need for much more than what we have now.
Okay. Can we go back to Gavilanis, please? With regards to precisely where that's at. I think you said somewhere there's been a bit of a delay at the moment, nothing significant. But when is there the next meaningful announcement on that, and people get a sense of again how you monetize that, because that's what you're in the business of doing.
Absolutely. So Gavilanis, the gating item for that was the 43101 report, which we updated and released. We worked with MDA. MDA did the resource over at Mako on San Albino. That was done by Steve Rusforcelli. The resource on Gavilanis was done by Derek Unger, who works directly for Steve and Matt Gray out of Resource Geosciences de Mexico. So that has been redone. What it shows is a smaller tonnage. The ounces actually held up pretty nicely, and the grade went way up from what was previously estimated. because there was more discrete modeling of the mineralized zones that actually have mineralization that we care about, which is silver. So 85% of the deposit is silver now. And, the lead, zinc, copper, and gold. I love gold. I care a lot about it. But in this deposit, it's primarily a silver deposit. So we focused on the veins that have silver and left everything else for geologic theory, which is where it should be. So that was modeled, in a much more focused way. That resource came out right on time. Problem is, we have to wait for the exchange to approve this transaction. It's not just going to be Gavilanis. We're going to add a second asset to this new co, which is the Commonwealth Silver and Gold Project in Arizona and Cochise County. And that has a resource that needs to be updated as well. The work is done. Again, it was MDA. This time, Steve led the effort on that. And Matt Gray, who's going to be doing the exploration for both projects. He has offices in Arizona and offices in Mexico, so he's the perfect guy to do this. He works for companies like Orla and other companies operating in northern Mexico, southern US. So he's perfect. But we are right now waiting for the exchange to approve everything, to give comments and feedback so that we can actually execute on this. But from our part, we've done everything. There's 2 43101s ready to go for Gavilanis. It's been posted on CDAR on our website. Commonwealth is owned by Wexford, so it's private. It doesn't have to be posted anywhere until this thing is out in the open in a public company. But we've done our part. We're just waiting for the regulators to do their part.
Okay, so well done on the 10 million. So you've got 13 million in the bank. The bit that I think the market wants to understand, and I think you sort of answered a little bit, was is the dividend policy which you're hoping to implement and the share buyback plan that you will announce maybe at some point, is it sustainable? I think based on the numbers that you said, the answer is no, but you don't mind pressure that you put on yourself to have to deliver a solution which makes it sustainable in the near term. Is that fair to say? Because if you don't do anything meaningful in the next 2 years, it's not sustainable. But your intention is to make sure that you do something which can increase the revenues coming in over and above San Albino, and that you will solve that problem.
Yeah, and I trust the market to be able to make these decisions itself. So the way that'll work its way out is maybe Franco-Nevada's dividend of 1% or 0.8%, whatever it is what it is because people are assuming they're going to get it for 100 years. Whereas our dividend yield is higher because people are questioning whether it's sustainable or not. I'm okay with that. It's up to us to make it sustainable, to take steps to add assets, to get a better yield on our cash that can allow us to pay that. I think San Albino is going to surprise a lot of people. I had a conversation with Akiba, my partner, the other day about this new area that we're getting ready to start mining called Aras. It's a vein. So the way the system in Nicaragua works is that it's a series of stacked veins. So there's one on top of another, and they kind of dip at 30, 35 degrees. They dip with the topography of the land. So when we're mining, for example, right now, we're mining the side of a hill. It's an open pit, but it doesn't look like a pit yet. It looks like we've turned this hill into a pyramid, because we're mining along with the topography. As we mine deeper, there is going to be a pit that starts to develop. But that's the way these veins work, because they're stacked on top of each other. And since the resource came out, we have added a number of ounces in this new area, Aras, which is a deeper vein that's going to pull the pit lower. And we're just figuring these systems out. At Conchitas, which is more of a virgin deposit, San Albino has had a lot of mining, even going back to the Spanish times. And then, around the turn of the 20th century in the early 1900s, you had an industrialist from California named Charles Butters who, took a stamp mill down there and had a mine, so there's been mining at San Albino. Las Conchitas is more virgin. And it's good and it's bad. It's good because most of the mineralization is still there waiting for us to mine it. It's not as good because we don't have these historical workings to say, okay, well, they were here and they left this behind, and this is how the vein dipped. Those voids actually give you a lot of data because they were mined, and you can assume that there were veins there that they mined. So we don't have that at Conchita. That's good and bad, but we're figuring this system out where we continue to add more. Now, what I would love is a step change, is to be able to tell you, Matt, we found a mother lode and it's going to be 1 million ounces and it's going to allow us to have a mine life for 10 plus years. I don't think that that's ever going to happen at San Albino. It's going to be incremental. Oh, another 50,000 here, another 60,000 there. This new pit has 150. That one, oh, it's the biggest pit that we have. It's going to be 250,000 ounces. And, but it's going to be scrappy, but huge margins because of the grades and because of our efficiency in mining. The mining costs relative to the strip ratio makes this project work. And I would love to be able to tell people, okay, in 5 years' time or in 3 years' time, San Albino plus Las Conchitas with the 3% we have over here and the 2% we have down here are going to give us all the cash we need to continue paying this dividend at that rate. But we actually don't have the data just yet to be able to do that. But we do have a lot of information because we run both companies to know that we're on that path. And so the number we picked, we didn't just pull out of thin air. There's some logic behind it. And yes, it's aggressive. It's a goal, but that's how companies are run. You set goals for yourself. This is just a more direct one. We're out there, we're putting our reputations on the line. We're giving ourselves a couple of years with the cash we have on the balance sheet, which we're comfortable with. And then we'll look, if at the end of the day, the dividend has to go to 750,000 a quarter or something like that, it's not the end of the world. We did our best. We did this for the benefit of all shareholders. I was thinking about an analogy this morning when I was on my run, that you have de novo companies that get started and they hire all these guys. They're good guys and they're paying themselves a lot of money. And they're going to go out and find assets. Nobody ever said, hey, your overhead's now 3 million, 4 million a year, and you've got no revenue. You shouldn't be doing that. So at least we're paying it to shareholders. I think that's a more pure way of tackling an issue of putting pressure on to grow.
It is. I think hat was the word you're looking for. You didn't pull the number out of your hat. Say that.
I just went to thin air.
Yeah. No. Okay. Well, look, I agree with you. Your last point there is at least this isn't you're not blowing money with stuff which isn't adding value. At least it is going to shareholders. So yeah, that's a positive. Okay. But look, I think that the key thing is you've got some of the numbers, some of the other numbers you're going to discover along the way, and it's a problem that you have laid at your own door. You're okay with the pressure of doing that. You've got a couple of years runway to do so. And that's what I think the market's going to be interested in discovering from you over the next, the next coming months or so. But just want to say, look, thanks for your time today, Cesar, because I know you're busy. Well done on the transaction yesterday. I think that's a biggie. Stay in touch and let us know how you get on, okay?
Thank you, Matt. Always like these interviews.